Hello, hello. So I am gonna do one of these reach me request videos today on real estate development. That's what I do most of my reach me. If you want to reach me and have me maybe do a video and pay me some money to do it, you can go to reach me to the reach me link to reach.me and find John Sonmez on there or click the link that should be in the description. Hi, John. I'm receiving a condo as a gift from my dad and it's currently paid off. The condo is currently worth 100K. Oh, that's pretty good. Can't we all receive gifts from our dad worth 100K? That's pretty good. All right. Currently, there are no, you're going to get some hate, dude, from this, but good thing you're anonymous because I think a lot of people that are watching this video are going to be like, fuck that guy. All right. Currently, there are no reserves for capital expenditures, reserves for repairs, and property management in place. Okay. So, not looking so much like a gift now. Current balance sheet. Income rent is 750, total income 750. Okay. Expenses HOA 300. Oh, that hurts, but that's how condos are. Look at this. You get rent 750, but then HOA 300. Fuck, that hurts. Insurance 31, property tax 36, water and garbage 100. Oh, that hurts. So now you're taking 400 out of this, just like so. Yeah, tenant should probably be paying that, but you know, you might only be able to rent it for 50. But okay, I'll just give you a quick side note. I would rather make the tenants pay for utilities than, and just because I feel like it's like you're going to get more rent for that, right? Because people don't really. I don't know. Tenants, for the most part, don't take into account that all utilities are paid, and so that's why the rent is higher, right? It'd be better to have a slightly lower rent, but I think you might be even be able to get the same rent and have the tenant pay the utilities because it's kind of an afterthought thing. It's like this is the rent, and then when they're signing the lease, you're like, oh, and by the way, you have to pay utilities. I'd rather have it work that way because I'm a sneaky bastard. I don't know. It just marketing purposes, right? You got to appeal, right? It's like this. It's like this, okay? But it's kind of not like this. But it's kind of like this. So like, have you ever stayed at a fancy hotel? And what do they do? It's like, oh, it's like X dollars per night, $150 a night, and then it's like, oh, plus the resort fee, of course, a resort fee of $30 a day, right? So you're paying an extra $30. So the rate is actually 180, but they tell you it's 150, and resort fee is it an optional fee. No, it's not an optional fee. You have to pay the resort fee. So it's really 180. No, it's 150 plus the resort fee. So that's kind of what that's like. You see what I'm saying? Like if they just advertise that 180, you'd be like, that hotel's too expensive. But when it's like resort fee, well, this is how you get internet and all that. Okay, so anyway, you gotta know how to play the game. Property management 0. Well, that's going to change. Repair and maintenance reserve 0. Total expenses 467. That hurts. Okay, so analysis: net operating income equals total income minus total expenses 283. Not looking too pretty here. That's not a lot of wiggle room, right? After I take it over, I'm hoping to add value to the property and change the balance sheet to hopefully something like this. Now, here's the thing, like, look at this. And this is a lot of times why condos aren't good investments, okay? As far as rental property, because of this damn HOA and all these expenses, this is a paid off condo. This is without a mortgage, right? So you rent this thing out and, hopefully you don't have any repairs. You're only putting like 283 bucks in your pocket a month. That sucks. Now, if you had a mortgage on this, you're fucked. You can't. How are you gonna wing this? Like your mortgage is gonna be. Let's say you had an $80,000 mortgage on that. That's gonna be like 300 bucks, 400 bucks at least. So you're done. Like you're done. All right. So pro forma balance sheet. Let's look at this. Okay. Income. So this is what he's hoping to add some value. So 1050. Vacancy rate 10%, so total income 945. Okay, good to account for the vacancy rate. Expenses HOA 300. Yeah, that's not going to change. Insurance, property tax, property management 105. Okay, what do we say about 10%? Yeah, okay, fair enough. Repair and maintenance reserves 100 bucks. It's light, but it is a condo, so the outside is not a concern. It's just the inside. So so that's an advantage there. So okay, so total expenses 572. Analysis: net operating income, total income minus expenses 373. Okay, so that's looking a little bit better. So, but let's calculate this. So we've essentially got $100,000 investment. Okay, and we're making 373 a month on that, right? If we're lucky. Okay, so let's say that we could even make 400 bucks a month. Okay, so if we make $400 a month on $100,000 property, right? What is that? Okay, so it's 400 times 12 is $4,800. Let's give ourselves even better. Let's say we get $5,000 a month in our pocket. Okay, out of a $100,000 investment, that's 5%. So we're probably looking at 4.5 to 5% return on our money. Not feeling too good about this. You see what I'm saying? Like, can we put our money somewhere else and get better than 4.5 or 5%? I think so. I'm leaning towards selling this thing, but let's see what the question is. Okay. In this scenario, even if I'm able to add value by increasing rent and having the tenant pay for water, garbage, return on the investment, not including depreciation, is look at that. Oh, I like you. You're smart. Good job. I've taught well. This is one of my coaching clients. So good. So you've calculated this out, and yeah, I said 4 to 5%, 4.476. Now, one thing not taken account in this is how you're adding value. You're adding money in. So maybe you're putting $20,000 of upgrades in. Ooh, that makes the return worse. So now you're working this off $120,000. So your return is like 4%. Yeah. Or less than that, maybe. Okay, not good. The first step once I get the property will be to increase its net operating income by adding value to the property, since that will be significantly helpful scenarios below. But after this, I have a few options here. I could refinance some or all of this equity to buy another property. Okay, I could sell this property and pay capital gains tax or do a 1031 exchange. That's what I am leaning towards. Okay, and then I could keep the property and just take the cash flow as it is. This is the worst option. Don't do this. Okay. In addition to this, I have another 40K to invest with, an initial 40K invest every 6 months. Given all this, what would you recommend me to do? I'm thinking I should either refinance or sell the property. I don't know which of these options I should choose. Could you show me some numbers here to illustrate trade-offs between different options? Thanks. I don't know if I can really like just bust out the numbers here, but let's talk about this. Okay. So refinancing this doesn't make sense. The biggest one is like, okay, so let's say you refinance to pull out money. So basically you put a mortgage on this property. It's not a good investment. Like the operating, like if we were to look at the cap rate on this, right? And here's the thing with investment properties, okay? Like this is kind of how it works is whatever the market cap rate is, okay? Let's say that the cap rate for a good investment property for like an B class property is 5% in your area. Okay, maybe it's 7%. I don't know, whatever it is. That determines what the price is. Okay, so what you want to do is you want to increase the cap rate, right? So that you can like basically you want to increase the value of the rents so that you can increase the price and keep the cap rate in the same scenario. So let's say you pick up the property and the cap rate is 5%, right? This is what we're looking at is 4.47. It's actually worse than that right now. It's actually like a 3 point something percent cap rate right now without raising those rents. Shitty, bad, not good, right? I guess this includes reserves and stuff. So maybe it's a little bit better than that. Maybe it is like 4 or 5%. Anyway, you increase the rent, okay? And then that allows you to keep the cap rate at what the market cap rate is. Let's say it's 5%, but the value is higher, right? The price will be higher. So you'll be able to sell it and flip it and make some more money, right? So basically, if you take it over and you can invest a small amount of money to raise the rents to 1050, right? And if you're smart, it's just one unit. Like I think you can probably write up some, if you're a good copywriter, you can write up some advertising and do some, like find someone that will pay 1050 for it. That's what I would do. Okay. So that's what I do is I raise this rent. I get someone, maybe I use even an incentive to get them to move in, give them 1 free month of rent to have them have a higher rent. So now I'm renting this thing out for a higher amount and I can now I can sell this thing for 120, maybe 130,000. Okay. So now I sell this thing and there we go. But let's again, I got sidetracked, but refinancing doesn't make sense because you're not getting a good value out of this already, right? The cap rate is already low. It's too low. You can find something better to invest your money in. So if you refinance this thing, I mean, even if you have this scenario, what if we refinance this, right? So what if we get $80,000? Let me run these numbers here, a mortgage calculator, okay? So we're going to say that the mortgage amount is $80,000, okay? And we'll give it like a 4% interest rate. Okay, it's probably, oh, guess what the monthly payments are? $382. Not good, right? Now you're negative. No, bad. Doesn't make any sense, right? And the thing is like, yeah, okay, so you can take that money and invest it somewhere else and get some cash flow and make up for it. But why? Like, why would you even, why hold the property? Like, it's better to just sell the thing. So I'm going to number three, or number two, sell the property. Now, paying capital gain tax or do a 1031 exchange. If you have other real estate property, you can take a loss. In fact, if you depreciate this property, you should be able to take losses. Well, if you have other properties, you could take losses, active losses in real estate. This is one of those things where if you have a real estate license, your losses aren't capped as well, and they're not deferred. So I'm not going to get into the whole tax law of that. But even paying the capital gains tax, I mean, just I say just do it. I mean, if you can hold on to this thing for a year and then you could pay the long-term capital gains tax, that might be worth doing. You could do a 1031 exchange, I suppose. Yeah, I mean, that'd be fine as well. It's not that complicated. And if you're buying a property, you got another 40K to invest. And this is one property, so it's not like you're trying to deal with 6 of these. I'd probably just go ahead and try to do a 1031 exchange. I mean, you could really see what the tax implications are going to be on this. I don't know, since this thing was given as a gift, is your basis zero in this, right? Maybe. It's if your dad still owns the title though, and he sells it, and depending on what he paid for it, his capital gains might be much less. So I'd kind of figure that out. But the worst case, you do a 1031. But that's what I would do, is I would get rid of this property. It's not a good property. It's not one that you want to hold. It's good to just have the cash, like improve it, get 120 grand out of it instead of 100, right? I think you can do that probably, and then invest this. But don't hang on to this. Even if you can't improve it, if you're just going to sell it, just sell it. Get rid of this. Buy something that's going to be much more profitable. It's going to have a higher cap rate. And that one you'll be able to enhance. I mean, if you can find a property that had already a 5% cap rate and you could do something to increase the rent and make it a 7% cap rate, that's great. That's perfect. That's good. Right. But in this case, this is not looking good. This is not something that I'd want to hold on to. Right. And it's going to be a little bit hard to sell because of this stupid HOA and stuff. Right. But here's the thing, is like this condo you could sell to an individual person, not an investor, because it's not necessarily an investment property, which makes sense. And also, like, do you want to go, like, if you just put it on the market now, you don't have to get property management. You don't have to worry about tenants and renting it out and all that stuff. I think that's the better choice. In fact, I would keep it empty. I would just sell it now, and I wouldn't get a tenant in there, because if you get a tenant in there, you're going to limit your market, like, that you can sell it to just investors, and they're going to see this is not a good deal, right? So you want to find a homeowner, someone who wants to live, you want grandma to buy this and live in it, okay? Or an investor, so you keep it empty. Keep it empty, fix it up. In fact, here's what you do. Don't put a tenant in there, but stage it. Okay, hire a staging company, put a listing out. Right, you're gonna have them come in and put furniture and make it look beautiful and decorated and everything, and that's gonna be your best choice. And then you'll get 120 for it. Pretty easy, I think so. So that's what I would do. Just get rid of this thing, get the cash, put the cash into something else, and be done with it. That's really your best option. All right, that's all I got for you today. If you haven't already, click that subscribe button below. Check out also my playlist on all my real estate investment advice, and I'll talk to you next time. Take care.